Let's get right into it. Monster Beverage just dropped his Q4 numbers. And look, on the surface, this thing looks like they're building a financial fortress. You've got net sales up, profits are just soaring, and they are absolutely crushing analyst estimates. But you know, here at Iron Financial, we don't just look at the surface. We don't just stand back and admire the facade. No. We take a blowtorch to the balance sheet. We stress test the foundation to see what it's really made of. So the question we're going to answer today is simple, but it is absolutely critical for your portfolio. Is Monster a solid pillar you can build on, or are we starting to see some cracks in that foundation that could bring the whole thing crashing down? Let's dive in.
You see, the headline numbers, they're solid steel. Anyone with a brokerage account can see that. But we're not here to look for a shiny exterior. We are here to examine the structural integrity. We need to know if this company is truly built to last, to weather any kind of market storm that gets thrown at it.
Exactly. It's so easy to get hyped up by big, flashy numbers. I mean, the market absolutely loves a good headline, right? But here's the thing. Headlines don't build a portfolio that can survive a recession. You can't retire on headlines. So we need to look at the blueprints, we need to check the wiring, and most importantly, we need to see what the people on the inside are actually doing with their own money. That right there is where you find the truth.
Okay, let's start with that shiny exterior, because you know what? It is pretty impressive. First up, the big one. Top-line revenue for the fourth quarter. We're looking at $2.13 billion. Now, Wall Street, the so-called experts, they were looking for about $2.08 billion. So that's a clean, solid beat by $50 million. Now, think about the environment we're in, where everyone's talking about consumers pulling back on spending. This tells you the demand for their product isn't just stable, it's actually accelerating. A top-line beat like this is the first real sign of strength. It tells you demand is incredibly robust.
All right, so revenue is strong. Now let's move down the income statement to where it really counts for shareholders, the bottom line. Earnings per share, or EPS, came in hot at 51 cents. The consensus estimate was just 49 cents, so again, another solid beat. Now this is absolutely crucial because it shows their pricing power is holding up strong against inflation. This isn't just a company that's selling a lot of cans, they're doing it profitably. They're managing their expenses, and they are delivering more cash to the bottom line than anybody expected.
And this slide right here, this just brilliantly illustrates the momentum we're talking about. Look, beating estimates is one thing. That's great. But look at the growth engine here. 51 cents per share this quarter versus just 38 cents in the same quarter last year. You do the math. That's over 34% year-over-year growth in pure profitability. That's not just growth, my friends. That is explosive acceleration.
Okay. I see the numbers. Revenue beat, check. EPS beat, check. Massive year-over-year growth, check. Impressive headlines, I'll give you that. But headlines don't build a portfolio. You cannot retire on headlines. So let's see the blueprints. Let's see what's actually under the hood of this thing.
That is exactly where we're going. We are going to break this company down piece by piece. First, we'll forge the full bull case, looking way beyond just the fourth quarter numbers. Then, we're going to get into the engine room to see where all this growth is actually coming from. After that, we inspect the foundation itself, what we are calling the fortress balance sheet. Then you'll get your chance to point out all the potential cracks in the armor. And after that, we'll follow the big money, the institutional players, and finally, we will weigh all the evidence and deliver the one and only iron verdict. All right, let's dive right into this first section, forging the bull case. You see, those powerful Q4 numbers we just looked at, they aren't some fluke. They're not an anomaly. They're basically the capstone on an incredibly strong year. And when you zoom out from that quarterly snapshot and look at the full year performance, the argument for this company gets even stronger. We're moving from a single photo to a full panoramic view of a company that is just executing on all fronts.
And wow, this full year picture tells an even more powerful story. With every single line item here, the case just gets stronger. For the full year 2025, net sales hit $8.29 billion, up almost 11%. That's strong, steady growth. But look at the next line, net income, up over 26%. That tells you they're not just growing, they are growing more profitably. And the proof is right there in the gross margin, expanding by 180 basis points to 55.8%. This means they have pricing power, and they're managing their costs like pros. And to top it all off, the market is rewarding them. The stock is up over 11% year-to-date, while the S&P 500 is, well, it's basically flat. This is the definition of a market leader firing on all cylinders.
All right, I'll give you that. The full year numbers do look solid. The operating leverage is clear as day. But growth is great, but where is it coming from? That is the billion-dollar question, isn't it? Is the whole machine running smoothly, or is there one massive engine doing all the heavy lifting, while other parts are just sputtering and leaking oil all over the floor? We need to break down the segments. Show me the engine room.
A very fair question, and this chart gets right to the core of the company. The Monster Energy Drinks division, just look at that growth, up almost 19% year over year in the fourth quarter. That right there is the massive, supercharged engine driving this entire operation. It is not just growing, it's accelerating. And right next to it, you see that? That's the engine that's on fire, and I do not mean that in a good way. The alcohol brand segment is down almost 17%. That's not a sputter, my friend, that's a full-on backfire. You're sitting here talking about a fortress, but there's a part of the business that is actively shrinking at a rapid pace. That's a problem. You can't just ignore that.
And oh, it gets worse. It's not just underperforming in sales. This segment is a financial drain. They took a $51.2 million impairment charge on it in the fourth quarter alone. Now, for those of you at home, that means they are officially admitting that a piece of that business isn't worth what they thought it was. It is actively costing the company tens of millions in write-downs. How can you possibly ignore a red flag that big? Look, I'm not ignoring it, I'm contextualizing it. The alcohol brands are a small, experimental part of the business. It's a side bet they took. You don't scrap an entire battleship because the lifeboat has a leak. You focus on the hull, the core structure that keeps the whole thing afloat. So let's look at the hull. Let's look at the real foundation of this company.
Exactly. Let's move on to the company's real strength. You know, the income statement, that's all about performance. But the balance sheet, that's about survival. It shows you a company's durability, its ability to withstand pain. And when we talk about a fortress, this is what we mean. This is where Monster's true power and resilience are revealed. And frankly, it silences a lot of the noise from smaller, underperforming segments.
Just look at this year-over-year transformation. It's incredible. Cash and equivalents jumped from $1.5 billion to over $2 billion. That is a massive increase in their war chest. Total assets are up from $7.7 billion to nearly $10 billion. The company is getting bigger, stronger, and more valuable by the day. But the most important line item on this entire slide is the last one. Pay very close attention to this.
0. That is the crucial number here. That is the kill shot. In one single year, they have completely eliminated all of their long-term debt. $374 million, poof, gone. Wiped clean off the books. This isn't just a strong company, this is a financial fortress. They have zero long-term debt and over $2 billion in cold, hard cash. They are immune to interest rate shocks, they can invest, they can acquire, they can weather any economic storm without ever worrying about creditors knocking on their door.
Okay, I'll give you that one.
Zero debt is a solid gold foundation. You can't argue with that. It's an incredibly powerful position to be in, no question. But a fortress can still crumble from within. And sometimes the very first people who know about the internal problems are the ones running the place. Which brings us to what I believe is the most important part of this entire analysis: the cracks in the armor. If the financials are this pristine, if the balance sheet is a fortress, and the core business is absolutely booming, then you have to ask one simple nagging question. Why are the insiders, the executives, the people with the most information selling their stock? We're now pivoting from the company's books to the actions of its leaders, and this, right here, is the heart of the bear case.
Just let this slide sink in for a moment. Over the last 6 months, there have been 5 major stock sales by company insiders. And during that same period, there have been exactly 0 open market purchases. Not a single one. So I have to ask the question that should be on everyone's mind. What do they know that we don't? Why are they cashing out when the story looks so good on the surface? This is a massive blinking red flag.
And this isn't just one rogue executive deciding to sell a few shares. Look at the hard data. We have Rodney Sachs, a key figure at the company, selling over $15 million worth of stock. You have Guy Carling, the president of Europe, the Middle East, and Africa, selling nearly $3 million. The chief commercial officer, Emily Turay, selling over $2 million worth. In total, this is over $20 million walking right out the door in just 6 months. These are the people building the fortress, and they're selling their shares. That tells me they might just think the price is at a peak.
Whoa, hold on. That's a classic bear argument. And look, it's a valid concern to have, but it completely lacks context. Insiders sell for a million reasons: diversification, taxes, buying a yacht, sending their kids to college, you name it. There are a million reasons to sell, but really only one reason to buy. You think the stock is going up. So instead of trying to read the minds of a few executives, let's look at the entire universe of professional money managers and analysts whose entire job, day in and day out, is to evaluate this stock and decide if it's a buy or a sell. Let's follow the big money.
And the consensus from the professionals, well, it's overwhelming. Just look at the complete and total lack of dissent here. We've got data from 8 different Wall Street firms that cover Monster. All 8 of them, every single one, has a buy or an equivalent overweight rating on the stock. Now for the big question, how many have a sell rating? 0. Zilch. Not a single one. The professional analyst community is unanimously bullish, and that is a powerful counterargument to the insider selling narrative.
And these aren't just some lukewarm buy ratings either. Look at the price targets coming from the major banks. Morgan Stanley sees this stock going to $96. Citi is at $90. RBC at $88. The stock is currently trading in the mid-80s as we speak. So the professionals, whose entire reputations are on the line with these calls, see significant future upside from here. They've run the models, and they believe this growth story is far from over.
Wait. Readings are just opinions. Price targets are just educated guesses. You know, they're cheap to produce. Show me the money. Don't tell me what analysts are writing in their little reports. Show me what the multi-billion-dollar hedge funds and pension funds are actually doing with their cash. Are the big institutions putting their capital to work and building up their positions, or are they following the insiders and tearing them down? Actions, my friends, speak much louder than research reports.
And here is where the picture gets very, very complicated. Look at the sheer size of these sales. UBS Asset Management dumped $1.63 billion worth of the stock. They cut their position by 77%. Janus Henderson and Ken Griffin Citadel Advisors also sold hundreds of millions of dollars worth, cutting their positions significantly. That right there is a massive vote of no confidence from some of the smartest money on the entire planet. But it is not the whole story. On the other side of that exact same trade, you have other giants building huge new positions. Massachusetts Financial Services bought nearly $500 million worth, increasing their stake by over 7,000%. Wellington Management added over $370 million. This isn't a one-sided story of everyone running for the exits. This is a clear, public disagreement among the titans of Wall Street. Some are taking profits, and yeah, they're big, but others are aggressively buying in, seeing a major opportunity. Okay, so this brings us to the final section. It is time to put all of this evidence on the scales. We have a clear conflict here, incredibly strong corporate fundamentals on one side, and some very concerning behavior from insiders and some major funds on the other. It's time to weigh the evidence and forge our final verdict. Is this an opportunity, or is it a trap?
Ultimately, it all comes down to this. The bull case is forged in the fundamentals. You have explosive growth in the core energy drink business, you have a fortress balance sheet with 0 debt, you have expanding profit margins, and a unanimous buy rating from every single analyst on Wall Street. The business itself is a well-oiled, powerful machine.
But the flaws are just as clear. You can't just ignore the struggling alcohol segment that's bleeding cash and requiring massive write-downs. You absolutely cannot ignore the significant, consistent selling from the top executives who know the company best. And when you see major respected institutions like UBS and Citadel dumping billions of dollars in stock, you have to pay attention. And let's not forget, the broader soft drink industry is currently out of favor with the market, which could be a headwind for the whole sector. These are not small issues. They are serious warnings.
All right, here it is, the iron verdict. Monster Beverage is a solid pillar. The foundation, that 0 debt balance sheet, and the booming energy drink segment, it is forged from solid steel. You cannot deny the fundamental strength of this company. However, the persistent insider selling and those huge institutional sales are legitimate warning signs. They are developing stress fractures that absolutely must be watched. So, our final take is this. The company is a fortress, but those cracks demand your attention. This is an opportunity, but it's one with clear, visible risks you can't afford to ignore.
And that leaves us with the final question that you, as an investor, have to answer for yourself. Is this constant stream of insider selling a true signal of a coming storm? Are they seeing something on the horizon that the public data doesn't show yet? Or is it simply smart money doing what smart money does? Taking some profits off the table after a fantastic run, diversifying their own personal wealth, and getting ready for the next leg up? The answer to that question will likely determine where the stock goes from here. Thanks for joining us for this explainer from Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.